battle with this, but I have an answer to this, and not everyone is going to agree with me on this. Jan and I had a coaching session this afternoon. We were talking about setting up a covered call search firm to quickly analyze covered call positions, maybe a week out in time on one stock only. We used the search tool to put that together. We showed him how he could use the option chain to also evaluate covered call comparisons, create his own search against his own stock list to do that as well. But that was at noon. Now we have another question. Which strategy has less risk and high probability of profits, vertical spreads or butterfly? My direct answer, not everyone's going to agree with this, and some people are going to comment on it, not maybe here live, yeah, but on the YouTube channel, but we'll see. Vertical spreads, in my opinion. Vertical spreads done correctly, meaning just what I said about an hour ago, that leveraged spread trades, we were talking about the zebra spread, buying a long call versus the married put, those leveraged positions, a leveraged zebra spread strategy will be fine in your portfolio in the right market conditions in a bullish market, and it gives you that better break even, not denying that, but it should probably only be 10 to 20% of your total portfolio. Mine's 12 to 15, and it's on bull put credit spreads, and it's on the search. 12 to 15% of my portfolio here are on bull put credit spreads in the right market. I'm going to extrapolate on that in a minute. Now, what I'm doing here is I'm looking for positions that match my criteria. I'm going shorter term, looking at a minimum 9%, but the average return is around 14.8, 14.9%, about an 87, 88% success rate. Looking for a probability of 85% or higher on stocks trading up. Technical stocks trading above their 20-day moving average, positive MACD cross at least 3 days, no earnings between now and expiration. And that's what I'm looking for. Now, right away, someone, and no one's done it on the webinar, someone's going to call me out and say, you can't make money that way. You're looking at the probabilities here of 85, I get it, but everyone is focused on this math of I make 14.9%, but I'm risking, it says 100.2%, that's impossible, but I'm risking 100% on the trade. And even if you're right 87% of the time, you lose 100%, 13% of the time and make this. My equations show me that you're losing. My chat GTP says you're not making any money. Okay, this is the structure and the initial trade we're looking for. This never is allowed to happen. We never take 100% loss on these positions. We close these out when they reach close to a 50% loss, which is still, by the way, only 13% of the time. And the remaining 87 are making 14.9. You never take 100% loss. You can never allow that on a vertical spread. An in-the-money debit spread with that high probability, or an out-of-the-money credit spread with a high probability. The math won't work. You're absolutely right. I will be destroyed if I allowed myself to even take a 70 or 75% loss. So you're saying, Mike, why are you taking such a low return? You could just use a 75% probability and make a 25 or 30% return. And what happens then is that, yeah, I'm looking at a 30% return. I'm risking a lower monetary amount. But if the stock moves or the market moves as they have in the last 6, 7, 8 years I've been doing this, I'm near 80 to 90% loss on that lower probability trade because I was closer to at the money. So for me, debit spreads such as this, credit spreads such as this, higher probability, 85% or more, seem to be more profitable. And you said, okay, vertical spreads. I think, and I have to state this, in the right market conditions, y'all. Right? When I see that market sentiment, let me go back here real quick, away from the search. Let's go back to the main home tab. When I see the market sentiment tools start to change to sell warnings, I'm closing out my bull put credit spreads, closing some of them out for most of 50% profit, maybe hopefully 60 or 70. And these are only 2 weeks out to start with, so it might be even higher. The market turns, or it's getting extended. I see the sell warnings start to appear in this market sentiment. I'm closing some of those or lowering my leverage on the bull put credit spreads. And I'm going to go into at or out of the money. I don't have it up here, but Bear Put Debit spreads. I'm going to go into Bear Put Debit spreads. I'm going to go into sample searches. I know I'm in bull call debits. I'm just doing this to save time. But there's the out in time bull call debit spreads. There's the default search in Bear Put Debit spreads. It's out in time Bear Put Debit spreads. These are longer term. It's a debit spread following what? The time decay curve we showed earlier. I'm going at the money to get closer to a 1-to-1 risk-reward ratio. Stock at 180 on Morgan Stanley. If I'm bearish, I might sell that June 180 call, buy a June 175 call. We're at a 5-point spread, but I'm only paying 263. Now, the probability is only 50%. But I'm not looking to make maximum profit, y'all, in this position. Oh, this is the bull call debit. I'm sorry, guys. That's not going to work for us. Let's do the Bear Put Debit. Opposite strikes. And let's just go out to April, 70 days. That would probably be my target. So I'm going to sell the 180 put and buy the 190. I'm doing a Bear Put Debit spread now that the market sentiment has shown me that it has the potential to turn. My bull put credit spreads have been profitable in extended market. Perfect. I'm risking 540. I'm at 82% return, almost a 1-to-1 risk-reward ratio. I am not holding this till April, y'all, and trying to make $452. If the market turns as I'm expecting, let's extend this out, sorry, there we go. When the market turns as I'm expecting, I'm going to close this out, just like I mentioned the long call traders might do, or the zebra spread traders would do from a previous discussion, when I hit maybe a 50 to 60% profit. That might be in 20 days. That might be in 30 days because the downturns aren't as extended. Why is the bull put credit spreads starting with that? Because 70% of the time, 72% of the time, the market is bullish. Follow the trend, right? Now you're going to have whipsaws, and we've been whipsawed left and right all over the place this week. I get it. There are certain instances where there's other hedge strategies. We talked about this last week. Buying strangles on SPY, I might use to hedge this leveraged portion of my portfolio. Calls on the VIX. We're going to show you those profits next week of what we did on January 5th till up until this week with both of those hedge strategies in our portfolio and how they helped hedge our bull put credit spreads and more. So I get it, right? You're saying you can't make profit on this. There's only a 50% probability, but I'm not looking to make that. I have a risk. I have a high risk, 100% risk, and I just talked about this. But it's with proper allocation. It's only 12 to 15% of my total portfolio. And I'm going to close out if I hit a 50% loss. That's just a no-brainer for me. I'm not allowing it to go to 60 to 70%. I'll try to find one of our videos for you later using the trade simulator tool where I show just how devastating that can be, even with an 87% probability and making 15% success 87% of the time, but allowing a 65, a 70% loss instead of a 50, it destroys the portfolio. It's very important on leverage spread positions. Just as we talked about earlier, keeping the loss in the portfolio and the loss to single digits, not falling into the lie of leverage. All right. Now, my initial, let's go back. I'm sorry, I got to go back one. And we're going to go back to bull put credits real quick. We're going to go into search. And yeah, I'm doing a position that has an 85% probability. I'm sorry, we were at Hershey. 85% probability above using the 220, 217.5 puts on a stock trading at 231. I'm getting a measly net credit of 33 cents. I'm risking 218. We're a 7-to-1 risk reward ratio. You put that into your thing and says, Mike, if you make 33 cents, 86, 87% of the time, and you lose 218, 13, 14% of the time, you're going to lose money. And you're right. There is no fire and forget options trade. Every one of them is going to require management if you want to increase profits and manage risk. That's what is so great about options. Options give us options, but there's no real fire and forget position to try to meet the goals you're potentially looking for. Mike, you're not going to hit your goals with this. Well, okay, I'm not, if I allow it to go to 70 to 80% loss, I would never allow that. Okay. But yes, I'm hitting my target goals with my structure, my search here on Power Options, and how I manage my bull put credit spreads. Different ways to manage them. I have 8 ways to manage a bull put credit spread that I use in certain market conditions, right? But I'm at a 7-to-1 risk reward ratio. That out of the money bear put debit spread I just showed you with the 1-to-1 risk reward ratio is kind of cool. But now you say, Mike, on Hershey, you'd make so much more money. You just go 14 days out in time. You give me a condor. I'm sorry, you give me a butterfly. We sell the at the money 230 call. We sell the at the money 230 put. We buy the out of the money 227.5 put, and we buy the out of the money 235 call. This is an iron butterfly. Okay, similar to the iron condor, but we're selling right at the money. Oh, did I skew? Oh, I did. I had to skew. Okay, let's clear this out. I have to use the 225. Oh, my apologies. I didn't realize that I should have realized it jumped to 5 points above 220. That's fine. That's fine. We're going to use the 230 and the 225. Nope. 225. Sorry about that. I want even distribution so it looks more clear. 225 call, 235 call. Clear this. Buy that. Okay. Sorry, folks. Let's get a true iron butterfly. Absolutely. So, my bull put credit spread, 85% probability, 7-to-1 risk reward ratio, but in reality, because I never allow any loss of 50%, it's a 3.5 to 1%, essentially. 3.5 to 1, okay? That at the money bear put debit spread I showed you, 50% probability, but a 1-to-1 risk reward ratio. But I'm going to close it if I hit 50% of the expected profit or 50% of the maximum loss. Mike, this butterfly kills your structure. I put this into an equation that says I have a position where I received a net credit of 425, or in other words, I can make 425 if I'm right, while only risking 75. It's essentially a 5-to-1 risk reward ratio. Oh, I'm sorry. My apologies. My apologies. It's essentially a 1-to-5 risk reward ratio. I'm risking 75 to make 425. Mike, you are going to kill this. This structure, this butterfly structure would kill any credit spread, any debit spread that you could put up against it. Let's talk about reality. Okay, let's talk about reality. You take this number, I can make 425 if I'm right, and I only lose 75, sorry, 420, let's call it 450, and I can lose 75 when I'm wrong. Mike is risking, what was it, 266 on a 5, I'm sorry, it was 218, let's just say, to make 32 cents on a 250 spread. They're reversed, but you see what I'm saying, right? Mike, you're risking way too much to make too little a profit. This profit on a butterfly is here, and here only at expiration, y'all. Back testing this 3 years ago, just putting on iron butterflies on SPY in a melt-up market, this maximum profit occurs 0.1% of the time. And then we start referring to it as the Christmas tree graph. What I mean by the Christmas tree graph is that running those back tests, this is 0.1% of the time. This profit range is almost 1, but it was below 1. This profit range was about 5% of the time. This profit range was 11. And I think maybe it's skewed a little bit higher, but you see what I'm saying? This was in the 20% range. This was in the 30% range. Some wins, some losses. And then down here, the maximum loss, this was about a 20%. No, it's a little bigger. It was about a 20% range. And down here at the maximum loss was about a 5 or 6% range. Just like the chart itself, it's the Christmas tree. You have the best risk reward ratio with a call butterfly, put butterfly, or an iron butterfly. The best reward to risk ratio. I am not denying that. On paper, on a graph. In reality, your true profits are roughly around here, assuming no management. Butterfly is a neutral position whether you use all call all put, or the iron condor, or iron butterfly, excuse me, I'm showing here. It is the neutralist of neutral positions. You don't want the stock to move at all. You don't want it to do anything. In the last 3 years, in the last 5 years, in the last 7 years, even leading up to the pandemic in 2020, can you think of any time where you've been confident to enter a position where you expected no market movement? The closest would have been the melt-up market of 2021. That would have been the best time to do iron condors, or all call or all put condors, in my opinion, possibly the butterflies as well. But rights and obligations, y'all, what have I done here? I've sold a 230 call and a 230 put, and my protective wings are 5 points away. The minute the stock moves up, I have an obligation to deliver 100 shares of stock of Hershey at 230 that I do not own. I can be assigned on that at any time, and my protective outer wing is not helpful. What does that mean? I essentially just shorted 100 shares of stock at 230. The stock falls. The 230 put is now in the money. I have an obligation to buy 100 shares of stock at 230. The wing doesn't click in until 225. I can be assigned early at any time if I'm in the money on this put option, which means I just bought 100 shares of Hershey at $230. $23,000 investment. Now I still have a put here to protect it. I still have this bear call credit spread against it kind of thing. The butterfly requires the most management, in my opinion, because you're doing all these different things with a butterfly. It's not just the iron butterfly. The all call even, the all put butterfly, the debit butterfly. When the stock starts to move up here, what are you doing? You've got to manage one side of it to create a new position. You're probably jumping into an iron condor because you want to be on these outer side wings, or you're moving the whole butterfly up to a new strike, which may actually lower your return unless you go further out in time. You're trying, oh, sorry, folks. Hey, stop that. You're trying to keep delta neutral, gamma neutral, delta positive, neutral, theta positive. I apologize. That's what I meant to say, theta positive. You're looking at all those different values and continually adjusting and moving this, or creating a condor, or turning it into a double bullish spread position or a double bearish spread position by swapping one of these options and doing this position. But again, based on your question, remember, this has the best risk reward, but the likelihood of the best reward is minimal. The likelihood of good return, good reward, is still probably only 20%, 15% without management. This is usually the target range that you'd see the stock, the position fall 50 to 60% of the time when you're just treading water. And then you have some of these maximum losses, which are only 75, but you're not getting this. Because once you start managing it, the peak profit is going to lower. Once you start rolling further out in time, the annualized return starts to drop. You're not getting that. Because even if you found the stock that stayed, or you were able to, the stock stayed right where it was, the implied volatility of the options and volatility in the stock would be so low that you would never see these premiums. That wouldn't happen. There's no risk on that trade whatsoever. It's like selling a call against a REIT that pays a 25%, 20 to 25, 13% annualized dividend. The out of the money call premium, or at the money call premium, to sell a covered call against that, even 80, 90 days out in time, is 4 cents. There's no risk on that trade. The benefit of trading that is just the dividend. It's not an options play at all. This is a pure options play, but it's based on pure neutral position. It requires a lot of management. And if you want to spend time on your screen all day, and you want to do the management, you want to watch your delta ratios, your gamma ratios, your theta ratios, and try to keep them in check each time as the stock moves up and down. Hershey's dropped 5 points tomorrow, or Monday, and then moves up 4 points the next day, then drops 3 points, then moves up 8 points. You're adjusting this position 4 times in the first 4 days of the trading week next week. You've got an entirely different position in the first 4 days if you're trying to keep the metrics correctly. So is this the best, what looks like up front, leverage spread-wise, the best risk-reward ratio? Yes. Is there any expectation you're ever going to see the best reward? Absolutely not. There's none, in my opinion. backtesting, actual trading, 0 day to expiration butterflies, and more, you never see that maximum return. You're constantly managing the position and adjusting it. Iron Condor is a little better, but less of a benefit risk reward. Comment away. I prefer the credit spreads that have worked for me, my structure, the way that I use it, and converting to the out of the money one-to-one risk reward debit spreads. And even I like to use Bear Put Debit spreads, but I even like to use the other at the money, out of the money bull call debit spreads that we clicked on because I didn't have Bear Put selected. An extra way to make some money. It's not bad. I just have better success with the bull put credits. That's me personally with my management techniques, because that's what I've done. That matched my goals, and that's how I set up the search to find what met my goals, back tested to find out what management I might need to make my goals, and that's 12 to 15% of my portfolio. So that's my opinion. Have a way at it in the comments, ladies and gentlemen. Take it away on YouTube. Talk to me about back spreads. Talk to me about the ratio back spreads. Talk to me about the zebra trade. Light it up. Educate every one of us, because in my opinion, the butterflies do give the best reward to risk ratio, but you never see the best reward, and you've got to manage constantly to make it worth your while. I've had much more success doing the high probability out of the money bull put credit spreads and sort of those one-to-one debit spreads when the market conditions are correct. I'm not always in bull put credit spreads, because when I'm in the sell warnings and we're in a bearish market, I'm in the bear put debit spreads. And then when I see the light buy warnings come up, I start to move generally back in to the bull put credit spreads as well.